Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain you, but to educate, to teach you. So call me at 1-800-743-CNBC, tweet me, Jim Cramer. Park exhausts me. I'm talking about my handy acronym for Palantir, AppLovin, Robinhood, and Coinbase. These are four of the many stocks that seem to have no quit in them, even if they all pulled back hard into the close today, giving us a rare moment to evaluate them on relative weakness. It's better for me to talk about these stocks on a down day so you can get a discount if you're so inclined. These park names are emblematic of how stocks have devolved into a two-track market. There's the S&P 500, and then there's this handful of stocks that retail investors have anointed and relentlessly take up without any real bounds. Today, with the Dow dipping 19 points, S&P inching up 0.14%, and the Nasdaq advancing 0.38%, most of the park stocks ultimately took a breather. Not a beating, but a breather. But if history's any guide, they'll bounce right back. Probably tomorrow. Now, even though I say park, these four stocks are just representatives of what's been going on in this market. They're actually the best of the lot. They have earnings. They have analysts following them who come up with estimates. Although, judging by the way people have been buying these names, neither of them, those things like estimates and analysts, seems to matter at all. Now, you've got, you've also got the nuclear power stories like Oklo, which sold off hard today, or the stocks that make for electric, make better electric vehicles, like the back from the dead QuantumScape, which makes a new kind of battery that's captured the fancy of retail investors, although that wasn't enough to prevent the stock from plummeting over 14% today. Although even with that decline, the stock's almost tripled over the past month, as have many of these stocks. These same people will buy anything quantum, anything rocket-related, anything crypto, including SPACs that buy crypto. Why these? Well, maybe the better question is, well, why not? If you're an individual investor and you don't have much information about how stocks work longer term, it's pretty easy to play this game, and it is a game. We know there are parlays in gambling where you have to pick two or more events and all have to be correct for you to win. The payouts can be big if your parlay hits, but if any bet loses, you lose the whole thing. These are pretty similar, except you tend to win all three. In many ways, gambling on park is a much fairer, better game. But it is a game nonetheless. This morning, Carl Quintanilla, of course, now we're talking about squawk on the street, asked if I believe in this kind of investing. Did I think it had any rigor? My answer was simple. It isn't investing. It's believing in something that may or may not come true. These stocks are taking place in what I call the year of magical thinking, which is a nod to one of my favorite writers, Joan Didion, although she was trying to cope with the death of her fabulous husband rather than using it as an investment strategy. The buyers are irrational believers in these companies, not from grief, but from glee. I then talked about someone I met this weekend, get this, who bought Oklo, who truly did not know what the company did, other than it had like something to do with nuclear, and it went up a lot. True, Oklo's involved with fission power. It can recycle waste as fuel. It might have a future. When the stock hit 30, I was adamant that people had to be careful with it. But then when it went up another 10%, I threw in the towel. I said, hey, listen, it's a speculative stock. If you want to own it, go ahead. It can be Oklo. It can be any part of the parks. It could be a strategy, the old MicroStrategy, or any of the SPACs that are being created purely to buy crypto. Or it could be Rocket Lab to supplement the rocket fleet for satellites. Oh, hey, how about Rigetti Computing? It's a quantum company. QuantumScape for faster electric cars. Joby Aviation, flying cars. Circle Internet Group, the red-hot recent IPO that I'm not particularly fond of because it's a stablecoin play. And pretty soon, because of that Genius Act, I think we'll be flooded with stablecoins. Now, I don't care which one you pick as long as you don't flood the zone with them. But I no longer try to stop people because there's just too much money being made, and I don't want to stand in the way of you making money. However, when you've got a big gain, you do have to take something off the table. That's the only time the discipline really does pay. What are the signs that the year of magical thinking might be over? Like maybe you think today might end it? I don't know. How do we return to rationality? Let me tell you what you need to see before this kind of thing goes away. I want you to know that we had a period like this in 1999 leading up to the dot-com crash. Things just kept going up and up and up, but the comparisons to the dot-com crash do not hold up under close scrutiny. While flying cars and experimental batteries don't yet make money, Park does. Lots of it. Oodles! Palantir, AppLovin, Robinhood, Coinbase, they are all pretty darn profitable. By comparison, during the dot-com era, most of these red-hot companies had little to no revenues and were actually running out of money, constantly tapping the public markets at the same time that insiders were furiously sell their own stock because they knew there was no justification for these sky-high valuations. They got out. Most of the dot-coms were not ready for the prime time. This move, on the other hand, is unlike any I've ever seen, except for maybe 2014, which was filled with tech success fueled by the rise of the cloud. But it ended when insiders sold a huge amount of stock into a host of underwritings. The cloud stocks then fell under their own weight. That could happen. If you were to contrast that with now, while we've seen some insider selling, we haven't been confronted with the avalanche of new offerings that usually stymie red-hot stocks. Normally, there would be tons of new nuclear and quantum and crypto IPOs to the point where the supply would only overwhelm the demand. That has not happened yet, at least not yet. Now, I'm reading a lot of stories about how these companies are way overvalued and have no business being this high, to which I say that means nothing to the buyers. Remember, we have two markets. There's the market that plays by the rules, and here I'm thinking about companies that report and go down because they don't meet expectations. And think about like Netflix or American Express, more on them later. And then there's the second market, the red hots, which tend to get a pass either because there are no expectations or because the buyers don't want to be confined by something so pedestrian as the four walls of the spreadsheet. They think these estimates are for small thinkers. They think big. They don't want to be at octa, where the expectations are hard to beat. They want to be at oclo, where there are no expectations. Will they ever be tempted to go into a traditional stock? Only maybe a few tech stocks called the Magnificent Seven, but those are no longer so reasonable because they don't have to beat the expectations. I'm saying they have to beat the expectations. I'll give you an example. Alphabet's going to report this week, right? Its stock was up big. They have to meet the expectations, if not beat them. I wonder if people will care who are part of this meme trade, there I called it, which is Park. With the exception of NVIDIA, the Magnificent Seven are not exactly a part of the year of magical thinking. But when you see a digital galaxy or a quantum computing, just remember to play it as it lays. Here's the bottom line. Aside from the occasional pit stops like today, the Park stocks just keep running. And until we see a wave of new IPOs creating a supply glut and a ton of insider selling, I wouldn't be surprised if they continue to rally. Let's go to Larry in New Jersey. Larry.
Hey, Jim, big booyah to you. Hope you're having a great summer.
Larry, it's been a terrific summer. I haven't caught enough fish. But in the garden, like the sun, what's the problem here? How about you?
Good. You can't ask for better summers. The weather's been great. Anyway, I'm a new recent club member. Company I'm calling about recently reported earnings in June, $5.06 EPS, beat estimates, $5.87 billion in revenue, even guiding higher, albeit slightly lower margins. You know them as for Photoshop and the standard for PDFs, Adobe. Going from 420 down to 360s now. What's your stake? Buy, hold, or sell?
Boy, Larry, I got to tell you, this is a tough one. One keeps going down, but two, Figma's about to come. And you know a lot of people have switched from Adobe to Figma because it's much cheaper. Let's let the Figma deal come and then see what happens. Might get this thing at a cheaper price. I want to go to Chris in New York. Chris.
Hey, Jim, this is Chris calling from Buffalo, New York. Third-time caller.
The home of the B-Bouts. Yes, let's go to work.
I was looking at a stock last week, and then it got a real bad downgrade right before the weekend. The stock is CoreWeave. What do you think about it?
I think I like CoreWeave, and I like Michael N. Trader, but I would say the stock is $60 billion, and it's going to have to come down and cool off a little bit. There are too many shorts in it. The shorts are covering right now. Once they're finished covering, I think the stock does drop. And you can take a look at it then. Let's go to Brian in Michigan. Brian.
Good afternoon.
Good afternoon. Go ahead.
My question is, I have a little Boeing that I bought.
Then get more Boeing. Get more Boeing. They report this week. I think it's going to be a terrific quarter. Let the stock come in. If it comes in down, let's say it comes to 220, here's what you want to do. Buy. Pull the trigger. All right, these Park stocks, well, they keep running. We got a little bit of a break today. That's why I wanted to do this piece. They don't care about the headwinds or fundamentals, the buyers. The only thing that could slow them down are maybe some new IPOs, maybe a lot of secondaries. Now, on Mad Money tonight, American Express fell after earnings, so what gives? I'm digging into the quarter and sharing if this might be a buyable dip. Then Netflix, another stock that fell after earnings, boasted that they had 95 billion hours that have been watched on this platform so far this year. So why wasn't that enough for Wall Street? Is anyone going to work? I'll give you my take. And Cleveland Cliffs soared 12% today. So what should we make of this incredible comeback? I'm going straight to the source with the CEO. He doesn't really care for Chairman Powell. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
There are some stocks that always seem to react negatively to their own earnings, even when the numbers are good. Stocks like American Express, which will widely sell off after nearly every quarter. Sell. Something I warned you about a week and a half ago. Don't want you in and out, but I knew that this could happen. And sure enough, when Amex reported last Friday morning, the company delivered a strong quarter, and the stock still tumbled $7 or 2.3% before slipping another 1.6% today. My gut instinct says that this will once again prove to be a good buying opportunity. But my brain says we need to do the homework and make sure the stock's still worth owning. First, let me walk you through the numbers. Got to start always with the numbers. American Express reported 7% billed business growth. That's total card member spending. And that was a little better than expected. Total revenues, net of interest expense, grew 9% year over year, also better than expected. And the company earned $4.08 per share. Wall Street was only looking for $3.89. That's 17% earnings growth. So far, so good. So that leads us to an obvious question. Why the heck did the stock sell off, aside from the fact that it always seems to sell off in response to earnings? Well, there are a couple culprits. First, despite the big beats for the quarter, American Express only reiterated its full-year forecast, which calls for 8 to 10% revenue growth and earnings per share of $15 to $15.50. That's up 12 to 16% from last year. It was not just a beat, not a beat and a raise, and that was the problem. Second, right at the beginning of the prepared remarks, CEO Steve Squeri noted that there had been softer spending in some travel categories, including airlines and lodging. Given that these are some of the biggest categories, I think the commentary might have spooked some people. But let's address these issues one at a time, because this is actually not, it's kind of a typical call. First, I'm not too torn about the fact that this was merely a beat and not a beat and raise quarter, and raise estimates later in the year. American Express issued its guidance at the beginning of the year, and there's tracking to hit the numbers. The company's revenue guidance implies steady growth in the back half of the year, and in uncertain times like this, I'm not going to complain about steady growth. As for the earnings aside, management always talking about mid-teens earnings growth, and that's exactly what they plan to deliver. This is the game plan. How about the second issue, the softness in certain travel categories? All right, not great, but you know what? In the very same sentence, Steve Squeri, the CEO, said that total card member spending was up 7% to record levels. Now, I'm old enough to remember a few months ago when investors were worried about a huge pullback in consumer spending thanks to all the tariff uncertainty. These results indicate that the total consumer spending didn't really come down much at all. And that's the positive surprise. Later in the call, in response to an analyst question, Squeri gave some more detail and explained that in the categories that matter most to Amex, premium seating for airlines, luxury hotels, younger consumer spending, all consistent. So with these main concerns about the quarter addressed, let me tell you the three big things that I liked about the quarter. First, I remain impressed by how American Express is doing on the credit quality front. Like many of the banks that reported, the company's total provision for credit losses was solidly lower than expected. That's great. Amex's reserves as a percentage of total loans and card member receivables remained at 2.9%, a healthy level where it's been for the past 4 quarters. Meanwhile, Amex's delinquency rate remains at a very low 1.3%. And the company's net write-off rate has come down a touch, both year over year and sequentially. Overall, American Express boasts delinquency rates that are far lower than the industry average, especially with its younger consumers. For its millennials and Gen Z card holders, for example, Amex has a 1.9% delinquency rate. Do you know what the industry is? 4.4%. This is American Express. They know how to filter out the, well, I guess some people call them deadbeats. I call them challenged. Speaking of young people, they're spending like crazy on the American Express cards. They break the U.S. consumer spending down by generation, and Gen Z spending was up 39% year over year. Gen Z, they're, well, whatever. And millennials are up 10%, 3 percentage points better than the total billed business number. Gen Z is still a small piece of the pie at 5% of the total U.S. consumer billed business. But millennials now account for 30%, slightly more than the baby boomer plus generation, which accounts for 29%. So when you're looking at, you're trying to game the long-term business here, the health with the success of young consumers, I think that's incredibly important. And this company has figured out, because you want to know what's the long term. Some of these guys are going to max out when the baby boomers are gone. Still, why is American Express doing so well with younger people in particular? That leads me to the last thing that I really liked about Amex's report last Friday, which is the way CEO Steve Squeri talked about some of the competitive dynamics of the credit card space. He explained that his company is winning because it offers the best value proposition, even if that's with a fee-based product. See, there have been some concerns about an increasingly competitive credit card market, especially on the high end, with a big push recently by JP Morgan to up its game in credit cards, a new challenge by an emboldened Citi, and, of course, the Capital and Discover merger creating a more formidable player. The latter, by the way, reports tomorrow. It's a big position for the Charitable Trust. Who knows what they're going to say? But Amex continues to do very well with attracting new cardholders, adding 3.1 million new cards in the quarter. 63% of these new accounts were millennials or Gen Z consumers. 71% were added with fee-paying products, which is one of the reasons American Express's card fee revenues grew 20% year over year in the second quarter. Same as the first quarter. It's incredible that these guys can still convince people to pay for a credit card when there's so many free options. Yet Amex's card fee revenue has put up a 17% compound annual growth rate since mid-2020, mid-2019. My wife loves the points. I never see them. When asked about the competitive credit environment, Steve Squeri, for the card, Steve Squeri explained that American Express has always operated in a competitive environment, and they pretty much always win because they offer consumers the most value, even if there's a fee involved. These guys offer hands down the best rewards for their card holders. So here's the bottom line. Once again, American Express sold off in response, so it looked like a good quarter, and just as predicted. My gut instinct says, you know what? This was what we said all the time. We said it would go down. We called it a buying opportunity. We waited till today, and history says that tomorrow's the day to buy. After looking through the quarter, I am now confident my gut instinct was right. Buy the dip for American Express tomorrow. Mad Money's back into the break.
Coming up, are you still watching this stock? Cramer's pressing play and looking at Netflix, seeing if the streaming giant can keep its momentum going. Next.
Every earnings season, we see a slew of high-quality stocks that rally going into earnings. Then, even if they report better than expected numbers, there's still a pullback. This is something we've seen repeatedly this earnings season. Tonight, I want to focus on another high-profile dip that we saw last week that really was pretty upsetting to a lot of people, and that's Netflix. Coming to the quarter, Netflix had been on fire, up a whopping 43% year to date. I even ran a segment defending the stock when it pulled back from its highs in April. After that, it rallied 29% before the company reported last week. But then, after the numbers came out on Thursday night, Netflix's stock tumbled 5% the next day before erasing some of that loss today, but not all of it. Sell. I think this is just like April, frankly. Once again, you're giving a chance to buy a terrific stock at a discount. Just look at the quarter Netflix reported. Starting from the top, the company grew revenues by 16%, slightly ahead of expectations. Management said that revenue growth was primarily driven by more member, a higher subscription pricing, and increased ad revenue. I mean, what's not to like about that? Even better, you've got higher than expected operating margins, which helped translate into 11-cent earnings beat off a 7.08 basis. That's not a huge beat, but it's certainly not bad. $7.08. Jeez. Now, Netflix has several blockbuster content releases fueling its performance. The second quarter content slate was headlined by the third season of Squid Game, which racked up 122 million views. But they had a bunch of other programs that racked up 50 to 60 million views, and the new Tyler Perry movie did 109 million views. In their letter to shareholders, management noted that membership growth came in ahead of their own expectations, and because of these great results, Netflix was able to raise their full-year revenue outlook by $1 billion at the midpoint. Management also gave great guidance for the current quarter. So why on earth did this stock plunge 5% on Friday? Now, part of it comes down to great expectations, Mrs. Haversham. With the stock up 43% for the year going into the print, sometimes even a beat and raise quarter just isn't enough. But part of it relates to some legitimate worries about engagement. Netflix said its users have watched 95 billion hours of content this year, yet that was actually a disappointment to some investors, up just 1% year over year. That was asked about multiple times. That gave the bears enough ammo to argue that future growth for the streaming giant could indeed be slowing. Okay, I think that's short-sighted. Netflix's content slate for 2025 is heavily weighted to the second half of the year. This, combined with membership growth picking up late in the second quarter thanks to the new season of Squid Game, sets the stage for a strong second half. That includes a bunch of new seasons for popular shows. And by the way, here's one that everyone in the office is buzzing about. Adam Sandler's widely anticipated Happy Gilmore 2. I liked Happy Gilmore 1. One of the greatest cash grabs of all time. Hey, it might even be good. All right, I'm looking forward to the documentary about Jerry Jones. We featured him on Mad Money. He's the owner of the Cowboys, which comes out next month. And don't forget about season 9, Love is Blind. Or how about this, the new documentary with Victoria Beckham, a.k.a. Posh Spice for those who were around in the 90s, ancient history. On top of everything else, Netflix keeps leaning into live content, especially sports. They got a bunch of big boxing matches this quarter, like Taylor versus Serrano rematch, and then the much anticipated Canelo versus Crawford fight on September 13th. Look out a little further. Get this. They got an NFL double header for Christmas Day, featuring the Dallas Cowboys against the Washington Commanders. That could be a good game. But the best game is going to be the Detroit Lions against the Vikings. The Vikings are much improved. Two divisional matchups that are sure to get people watching. Plus, just last week, Netflix scored 120 primetime Emmy nominations across 44 titles, underscoring its creative dominance. Management also pointed out that during the last quarter's conference call that no single title accounts for more than 1% of total viewing. This speaks to the breadth of Netflix's offerings. Even if you haven't heard of some of these shows, millions of others have. At the same time, Netflix is seeing great success with their local-for-local content strategy, developing shows and films in foreign languages to connect with audiences in those countries. This past quarter, they had some big international hits. Extraterritorial, it's Extraterritorial, from Germany, which became the fourth most popular non-English film after 89 million views. In fact, non-English series and films made up more than a third of Netflix's viewings in the first half of the year. You ever heard of titles, people? Now, management's increasing their investment overseas in places like Spain, where they're doing really, really well. Netflix will be pouring over €1 billion into Spain between 2025 and 2028. This is in addition to the partnership with TF1, a leading broadcaster in France. Of course, the company's still investing heavily in the United States, as America still makes up the majority of their content spending. Management estimates that Netflix has contributed $125 billion to the U.S. economy from 2020 to 2024. And they're planning to continue these investments with an expansion in Albuquerque, New Mexico, along with roughly $1 billion, going to a production facility in Fort Monmouth, New Jersey. Meanwhile, their ad business is scaling rapidly. Netflix Ad Suite, their proprietary first-party ad tech platform, has rolled out globally, and management expects ad revenues to roughly double this year. Double! They're also optimistic that the redesigned TV homepage will give subscribers better recommendations for making it easier for them to find the shows. Right now, I really don't like it. They're looking for, with the aim of boosting long-term engagement. Thank you. Management even had some positive commentary on the future of AI for their industry, noting that they believe, quote, AI represents an incredible opportunity to help creators make films and series better, not just cheaper, end quote. That said, I'm sure cheaper is kind of a big plus. For some of their hit shows, hey, in Argentina, the Eternaut, that's E-T-E-R-N-A-U-T, the production team leveraged AI-powered tools to generate a scene where a building collapsed in Buenos Aires. Management said this sequence was completed 10 times faster than it would have been without these tools. And in terms of cost, they simply didn't have the budget to do it without AI. The sequence was actually the very first generative AI final footage to appear in a screen in a Netflix original series or film, which really showcases the power that these tools give the smaller creators. The bottom line, Netflix sold off after the quarter because the stock came in too hot. And the conference call only made me feel more confident about the future of the business. So did, by the way, the Q&A. I think you're getting a chance to own the best-of-breed streaming platform at a discount. Please read both the shareholder letter and the Q&A to be sure you don't make a mistake. Let's go to Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Of course, Jerry. What's up?
They call themselves the front page of the internet, and they're trying to fight AI with AI. Do you think that when they report in 2 weeks that Reddit will be on the top and bottom line?
Yes, I do. Absolutely. I think Reddit, last time it ran, it went up too much. It was way too hot. I don't know why that happened. I think that Reddit's going to have a really good quarter. I was shocked to see how much there was a big short position in it. But now I think Reddit's prepared. Steve Hoffman's really terrific. All right, looking at Netflix's results in the conference call, I think this pullback in the stock is a chance to actually buy a best-of-breed streaming platform at a discount. Much more made money, including I'd say, probably going to be explosive interview with Cleveland-Cliffs. Ever since President Trump doubled the tariff on steel imports, Cleveland-Cliffs stock hasn't looked back. I'm learning more about the current state of steel with the CEO. Then we don't talk that much about the impact of analyst price targets. But we should. I'm sharing why this is so important. Of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, what do we make of this incredible comeback in Cleveland-Cliffs stock today? The vertically integrated steelmaker focused on value-added steel products, particularly for the auto industry. This stock plunged from the low 20s early last year down to $5 and change this past May when President Trump approved, and you know I'm against this, the Nippon Steel acquisition of U.S. Steel, which Cleveland-Cliffs also wanted to buy. But shortly after the deal was approved, Cliffs got a gift from the administration. The president doubled the tariff on steel imports from 25% to 50%. In response, the stock jumped 23% in a single session, and it's never looked back because, well, the president may have saved the industry. And it exploded higher once again today, up more than 12%. When Cleveland-Cliffs reported a better-than-expected quarter, there's a sense that business will only get better as we process the higher steel tariffs. So can this thing keep running? Let's check in with Lorenzo Gonsalves. He is the chairman, president, and CEO of Cleveland-Cliffs. Find out more. Mr. Gonsalves, welcome back to Mad Money.
Thank you very much for having me, Jim. Always a pleasure.
All right. First of all, congratulations. I know that this quarter really wasn't aided as much by tariffs as it was just because you have good market power. You're in the right place. So tell us about what's happening at the firm, even without the tariffs, because it seems to be better than it was the last time I spoke to you.
Yes, it was, and you're right. And I'm not sure about market power because the power of the market is with the consumer, and that's a very open market, as you know. And we have competitors everywhere, but we are able to compete. That's the most important thing. As long as we take care of the assets that can't perform, and I took care of that last quarter, and it's a painful thing. But we shut down 2 plants in Pennsylvania. It's a place that really doesn't support Cleveland-Cliffs. They elected to go in a different direction. Good for them. It's fine with me. And one in Illinois. These were assets that are underperforming, basically due to the pressure on imports. And imported steel distorts the market. You know that well. We got tired of fighting, a fight that we can't win. The assets we have now, they are all performing. They are all good to go. And they are focused on markets that President Trump is really working to make sure that they are the foundation of the new birth of industrialization in the United States of America, automotive and electrical steels.
But you did say that there's a chance that some of those facilities contracted with J.P. Morgan could be sold and be excellent data centers.
Yeah, because we have a lot of power, electrical power available. Utilities in general, water. That's what actually data centers need, the availability of plenty of power and plenty of water. So we have both. And the location is very good for that. So we are not going to get ahead of ourselves, but we are receiving a lot of unsolicited inbound calls regarding those assets.
That's good. Now, do you think that people understand in this country that we've been a dumping ground for steel for years, and that's how we lost all our companies other than you and Nucor?
Look, it's about time to understand. And I believe that in my lifetime, I have never seen so much awareness about steel. Take what happened in Stilton. That was one of the 3 mills producing rail in this country. And the clients elected to import rail. And I tried, when the tariffs were at 25%, I tried to replace imports with rail made in Pennsylvania. But at that point, they had already cut deals to have the foreign mills supplying the rail through the tariffs. So that's an uphill battle. We can't win. Because if they can do it at 25%, they will do it at 50%. And as soon as tariffs move a little bit, they will be back. So we have to work for the long term. President Trump is creating the foundation for a rebirth of manufacturing, particularly automotive in this country. We have 8 finishing facilities ready to go. We are ready for the surge that we're going to have in automotive. And that's right now. Not in 2 years, not in 3 years, not in 5 years. It's right now.
Okay, so what happens to all the plants that were built in Mexico, thinking that that's what our government wanted? Because I have a lot of stuff in Mexico. Candidly, I'm right next to a plant, and I know that it was there because it was very inexpensive labor and not that good, frankly, environmental protection, unlike what you have to do. And it would be rather amazing if those plants suddenly closed.
Jim, the biggest problem is not even the plant being in Mexico. The biggest problem is the fact that the plants in Mexico that were supposed to be part of a USMCA entity and consume steel produced inside the USMCA in Mexico or in the United States or in Canada, started to consume steel coming from foreign countries,
right,
like Japan, like South Korea, like China, like Germany. So it became a dumping ground, and Mexico at that point was believing that they had a license to kill, a jail-free card, just because they were part of the USMCA. So the plants in Mexico, as long as they buy steel from the United States, we can work with them. But what we can't afford is to allow the plants in Mexico to use steel from, let's call, China or South Korea.
Well, it's transshipment.
Japan.
It's definitely transshipment. I believe that. I think it's ridiculous transshipment. Now, let's speak about the stock for a second. Had a very big move today. You do have some leverage targets. I know you mentioned at one point that you might even be open to foreign investment. Now, who would actually pass the test of a foreign investor? Because I would think that a foreign investor may be part of a problem, not part of the solution.
That's to be seen. That's to be seen. Like I said, we're receiving a lot of inbound inquiries, unsolicited inquiries, and we are discussing with people that are talking to us. It's too early to tell, but I believe that some are real and some are really acceptable as real partners. And when I say partner, I'm talking partner. I'm not talking a partnership that's actually a sale. I'm talking about a real partnership in specific businesses, niches, things like that.
Okay. Now, you were quite critical of Chairman Powell, and I wonder how much you think he really may be at fault here in terms of the inability to get the part of the country that you need to do better to get rolling.
Let's face it. At this point, people are not buying houses anymore because mortgages are unaffordable. And I don't want this thing to start contaminating the automotive market at a moment that automotive is going to be producing more and more cars in the United States. The consumer must be able to buy. We can't afford having interest rates so high, artificially high, for a Fed that is really with an agenda. There's only three powers in this country: the judiciary, the legislative, and the executive. The Fed is not a separate power. And Jay Powell believes that he is playing a counter to Donald Trump. And that's totally absurd. It has nothing to do with independence of the Federal Reserve.
You really think that that's his goal? I mean, don't you think he's just trying to fight inflation? He's a very good man, and it's tough for me to hear that. Look, I respect you entirely, but I have to respect both the office and Jay Powell. And I think he's just trying to make it so the American working person, including the people who work for your company, aren't overrun by inflation.
Yeah, he keeps repeating the same mantra. Yeah, data-driven, this and that. But at the end of the day, he's not even questioning the quality of the data or the type of the data. Let's talk about the employment. Employment at a low percentage, but a big portion of our workforce is now driving for Uber or DoorDash or things like that. That's not real employment. That's just a travesty of employment. These things are not reflecting the data. So I'm not questioning if he's a good guy or not a good guy. What I'm saying is he's a bad Fed chairman. He needs to go.
Oh, wow. All right. Well, look, Look, I don't want to leave it on that note. I would rather just leave it on a note of what you think you could do with a little less leverage, and what kind of earnings power do you think you might have now that the tariffs are in, and let's say the president is able to stop the transshipment from Mexico and from Canada, by the way. What do you think the earnings power you have at Cleveland Cliffs?
The biggest earnings power that I have is the ability to make happen what President Trump is trying to bring to this country. He's trying to bring industrialization back to the country. And the main driver for that would be the automotive industry. The more we produce cars in the United States, the more we'll be able to produce steel because we supply them. And with higher production, we dilute our fixed costs, our costs go down, our margins increase, and that's where my earnings power is. It's just pure common sense. We lost, Jim, in the last 5 years, more than 8 million cars produced in this country.
I know.
That's totally unacceptable.
I agree. I mean, they assemble them here, but they don't really make them here. Anyway, Lorenzo Gonsalves is the chairman, president, and CEO of Cleveland Cliffs, and it was a great quarter, sir, and that's what really matters, okay?
I really appreciate the opportunity to be with you. Thank you very much.
Of course. Thank you. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for the lightning round. Same as talk so about the buy shells, so just put another course off because I'm a step is aware from you play this out. And then the lightning round is over. Are you ready? Ski dead. Don't lightning round. I'm going to start with Michael in Tennessee. Michael.
Booyah from Clarksville.
Booyah, Michael.
I've got 3 infrastructure stocks. 2 of them have done really well. The third one I'm still waiting. What do you think of GVA, Granite Construction?
I've always felt that GVA was a takeover target. And by the way, it's up 7%. That's nothing to snooze. That's nothing to sneeze on. I do believe, just so you know, that I think that the infrastructure play is still on, and therefore Granite is still on. All right, now we're going to go to Ryan in Wisconsin. Ryan.
Hey, Jim. Booyah from Pleasant Prairie, Wisconsin.
Nice. What's up?
Oh, nothing much. Hey, I am calling about a company you talked about. I think you actually brought on the CEO a while back. The news around them has been recently fairly positive, and it looks like there's some momentum. I want to get your opinion on Solid Power.
Momentum? The stock's up 100%. That's big momentum. But when it's up 100%, then you know what? I think you got to do what I call a schnitzel. Take a little off the table because that thing has just been a horse. All aboard! Let's go to Todd in Texas. Todd.
Hello, Jim. How are you?
Todd. I am fine. How are you?
I'm pretty good. Hey, Elon Musk has called lithium the new oil, and I want to get your thoughts on ENVX. And
we have a glut of oil. I'm worried about that. ENVX is another stock that's just up way too much. I mean, we got to find some stocks that are not up like a straight shooter. Because what happens is these are what I call parabolic buys. And if you buy a parabolic stock, what happens is it goes parabolic down. So therefore, we're not going to buy that stock. Let's go to James in Minnesota. James.
Hey, Jim. With recent CPG sector deals like Ferrero's acquisition of WK Kellogg, Kraft Heinz potential breakup, how should investors view General Mills stock?
Well, the good news about General Mills is it's got a 5% yield. The bad news is that unless they didn't do what Pepsi did. See, when I was on the Pepsi-Cola call, listening to with Raymond McGuarta, he has managed to be able to somehow deal with the GLP-1s. General Mills has not been able to deal with them, so I've got to tell you, I am on the camp which says you can buy it because of the dividend, but not because of the earnings. That's a tough one. That makes it like a bond. Hey, why don't we go to Doug another in Tennessee? Doug!
Booyah, Ski Daddy.
Man, you got your day job all set. What's happening?
I've been a club member for over a year, and it's more than paid for itself, so I wanted to say thank you. Yes,
we have doubters right there. I'm looking at some of my doubters. They're not even paying attention to the show. Wow, they really aren't. Ooh. All right, let's go.
My son is 10, and he's just starting to get into stocks, and he's been watching you, and he wanted me to call in and ask if he should buy Starbucks now or wait.
Your kid's got horse sense. I would tell him to buy some now. The stock was down. That is the way to go. I like that. That's the best stock of the whole darn lightning round. And that, ladies and gentlemen, the inclusion of the lightning round.
The lightning round is sponsored by Charles Schwab. Coming up, a new week, a new price target. Cramer's laying out why we've seen an uptick in recent price target changes. What it means for your portfolio. Next.
We don't talk all that much about the impact of analyst price targets, but we should, because you can explain a lot about why so many stocks keep levitating almost aggressively. First, price targets matter. They give a broker or a trader a reason to call a customer. Broker's job is to convey whatever she can about a company, and a price target is something that needs to be conveyed. A trader may say, listen, I got 500,000 of the stock in question if you want to buy some. These analyst pushes can get stocks going because the process of contacting clients gives the stock in question a legitimate reason to run. Anything that can persuade big institutional investors can move a stock, and a price target boost definitely falls into that category. Now, how do I know this? I know this because I've been on both sides of these phone calls. First on the broker's side, then on the money manager's side at my old hedge fund. Maybe you think these price target adjustments shouldn't matter, but they do. Often analysts simply get caught on the wrong side of the trade, too. For example, Barclays seems to have bought into a theory that we're heading into a recession or something, or at least a capital spending drought. That hasn't played out. So today they raised a whole bunch of price targets in the capital goods sector, but they raised them to well below where the stocks are already trading. They took Caterpillar stock, for instance, 335 to 383. It's at 410. United Rentals, 565 to 620. Stocks at 778. The firm even had a sell on that one. Those are just plain wrong, and they still need the stock to come down a lot. A huge number of industrials had similar action and made buyers who missed them on the way up commit to buying some today. We see the same thing with tech, where analysts are playing catch-up with Texas Instruments. The negativity in tech has been so pervasive that it's haunting researchers everywhere. But now, when they raise the price targets, the stocks do go higher. Now, it's entirely possible that people were short stocks going into this morning. That same mindset pervaded the hedge funds, which are slaves to the yield curve, and the yield curve was giving off real sell vibes. Plus, the Liberation Day tariffs were supposed to be downright apocalyptic for the industrials. They look like the easiest short positions in the world, fish in a barrel. Then, when the presidency later reduced many tariffs, those short sellers got washed away. In the end, though, a lot of money managers simply failed to realize that the amount of money being pumped into the system by the big, beautiful budget will trigger huge buying. The short sellers were too worried about the deficit to read the fine print, which is filled with reasons to buy those stocks. Plus, over the years, these industrials have bought back so many shares that the float is very small. Therefore, it's imperative for the trading desk to get some stock simply to be able to have something to meet the orders that might come in when the brokers make these calls. They do so by shorting the stock to customers and then battling it to contain the short. Sometimes they can, sometimes they can't. And it's another reason the stock runs. So when you see what looks like a totally irrelevant price target moved up by a little, you should presume the analyst has people maybe short, the street is very skeptical, and the short sellers were run over by the bulls. And that's the process of how to make money in 2025. I'd like to say there's always bull market summer. I promise event just for you right here at Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.